3 years ago, I started investing with just £330. Today, my portfolio is worth over £70,000. And in this video, I'm going to show you exactly how I've built it. Hi guys, and welcome back to the channel. Now, this is my 3-year investment update, and it's the biggest one we've done to date. In September last year, I shared a full portfolio update, and the portfolio was sitting around £57,000. Now we've surpassed the £70,000 mark, and that's a gain of almost £13,000 in the space of 5 months. In this video, I'm going to break down every account and every investment and show you what's worked, what hasn't, and what my plan is to reach that £100,000 mark. Right now, my portfolio is split across 3 different portfolios. My first portfolio is over on Trading 212. And this is where I invest in individual stocks and have a slightly higher risk appetite. Then we'll move on to my InvestEngine account, and this is where I've built my own DIY global fund, and it's where most of my money is currently going. And finally, we'll look at my oldest and my largest portfolio over on the Vanguard platform. Towards the end of the video, I'll break down all the percentages and all those returns so we can see exactly how much money we've made over the last 3 years. So let's start with our Trading 212 account. Okay, so into the first account here. You can see at the top of the screen, all of this is invested within a stocks ISA. And essentially that just means that any investments or growth within this account are protected from taxation. So you can see the total value in this account is £6,852. And you can see that rate of return of 16.5% with a total return of £339. Now, if we look over the past week there, we've had a pretty bad time over the last couple of months. Over the past month there, down over £1,100. I'm not going to try and sugarcoat this. The market is in a bit of a dip, especially with the tech and AI sector, which you'll see in a second. So if we scroll down, let's have a quick look at exactly what I've got in this portfolio. So biggest holding is 100 shares of SOFI Technologies. I was really quite high up on this stock. So if we take a quick look in there, you can see we were up almost at the $30 mark per share, and we're now down at just $21.20 even. So, yeah, bit of a drop recently. If we go over the last 3 months, you can see we've dropped almost 25%. So, I do believe we're just in a bit of a temporary dip on this, and this stock will climb back up. But, yeah, in the past, we've definitely seen better returns with this stock, but still really hopeful with this account and that particular stock. So, yeah, I'm sure it will bounce back up. I've also got 400 shares in Grab. So for anyone who's unaware, Grab is kind of like the Uber, but of Asia. They have a lot of the market over there. Many people, if you go to Thailand, Asia, you'll probably end up using Grab. Uber haven't really managed to break into this market there. So Grab have a really strong position there. So down at the moment, it's very much a long-term play. Personally believe Grab is somewhat undervalued at the moment, so I'm going to keep my holdings at 400 shares for now, but I might top up given that we are down 20%. It'd be a good idea to average down at this point. Then got 7 shares in AMD, which at one point I was up over 100% on that, so we've come down slightly, but again, long-term hold, and the market is, the market sentiment at the moment is interesting to say the least. Stocks are bouncing up and down by 10% by the day. So, yeah, overall, I'm not too concerned. Next up, we've got Rolls-Royce there. Just 60 shares of Rolls-Royce. This has been a really quite stable stock, just a slowly gaining there. Next, we have Take-Two Interactive. So this is a gaming stock. This is the company that own Rockstar Games. And obviously, under that Rockstar umbrella, you've got Grand Theft Auto. So long-term play here, but I'm hoping the first 2 years after the new Grand Theft Auto 6 launch, we should get some nice gains there, but down at the moment on that stock. Haven't actually investigated why we're down recently so much on that stock, so I need to do a little bit of reading, but again, might buy another couple of shares in this soon, just to average down a little bit, but like I say, long-term play on that particular stock. Next, I've got Palantir. Again, this was up massively recently, and it has come down. So 4 shares in Palantir, up around 20% on that one. Next, we have Applied Digital. Now, it's a company I really like. However, I did get in at the wrong time. I was reviewing this recently, and it was at quite an all-time high, and that's when I chose to invest. So, look, I'm going to continue investing in this company sort of longer term. Probably need to take advantage of averaging down, but again, not a large holding, only 15 shares, currently valued at just under £400. Next is Marks and Spencer's, 95 shares of this. Fairly new position for me, this one. Did quite a deep dive into Marks and Spencer's. Really like the future potential and really like the sort of current business model and the changes that Marks and Spencer's are making internally. I'm unsure if this is a supermarket in the US, but if you're watching in the US, Marks and Spencer's is essentially like a supermarket and department store, but quite on the premium end when it comes to food. So yeah, I'm planning to do a deep dive on that particular stock in the near future, so I'll do a whole video dedicated to that company and why I'm investing in it. And then we've got just a single share of Google at the bottom there and a single share of Shopify as well. Again, very small positions, but Shopify seems to have absolutely plummeted recently. So yeah, overall, the performance in the past was greater. If I go back on this sliding scale here, you know, you can see it not too long ago, we were up over £1,500 in gains, and since it has really sort of come down. But again, the market has these dips, not too concerned. So let's have a quick look at now my other two portfolios, which are a little bit more stable. Okay, so now moving on to my InvestEngine platform, and you can see here the total balance is just under £18,500. This is an account that I started last April, so I've not even had this a full year yet. You can see here that I've essentially built my own portfolio within this app. I've called it the Elevate All World, and it's a distribution version. And again, if you find any interest in this portfolio, I will leave a link to this in the description. You can take a look at it. You can even copy it if you'd like. But again, it'll send you a link straight to this portfolio. So the idea behind this portfolio, for anyone new watching, it's my way of recreating the FTSE All World exposure. So basically creating a global fund, but utilizing 6 different ETFs. Now, you may be thinking, why have you not just simply used, you know, an all world fund? Which absolutely, you know, if that's the way to go. Keeping diversification there is really important. But the reason I did this, I took all the elements and all the sort of global exposure, and I found a lower cost ETF for each area. So if I have a look into the details here, you can see my portfolio total expense ratio there is 0.05%. Now, if you go for a typical all-world fund where it does all of this for you, you're looking at around 0.15, so around sort of 300% or 3 times the costs of this fund. The yield at the time when I built this as well, you know, the dividend payments were higher than the typical all-world fund at the time. And also, this gives me more flexibility. And what I mean by that is these 6 ETFs, which I'll go through in more detail in a second, you know, if I see a particular market that I think, okay, there's a great opportunity to buy here in Japan, for example, I can invest in just Japan within this. Whereas if your money is locked into an all-world fund, you have no control over those weightings. And therefore, if you wanted to invest in a particular region, you have to invest money in all the regions because everything's locked into the weightings of one fund, sort of one size fits all. And this gives me that flexibility to sort of change the weighting percentages and also add and withdraw bits if I need to. But this is my idea of a really nice diversified portfolio that I can keep adding money in, whether the market's high or low, which is exactly what I do. I mean, you can see there on the screen that I put £1,000 a month into this. That goes in at the start of every month, whether the market's high or low. It's just dollar cost or pound cost averaging into the market. So let's have a quick look over the past month. So barely any change over the last month in terms of gains. If we go to max, again, this is since last April, return rate there of 28.87% and a gain of 1,449. Which I'm really happy with, to be honest. Like I say, I've only put £17,000 in this, and it's so early for this portfolio that we've really not experienced any of that compounding growth yet. But if I go into the portfolio here, so SPDR, S&P 500, that covers obviously my US exposure. We've got VERX, which is the developed Europe ETF, but it excludes the UK, which I'll cover again in a second. You've got VFEM, which is another Vanguard ETF, which covers the emerging markets. We've then got the Amundi Prime Japan ETF, which covers obviously my Japan exposure. We've got the FTSE 100 covered by this HSBC fund, which is why the previous, this Developed Europe fund up here is excluding the UK, is because I've got my UK exposure in this ETF. And then finally, we've got the Developed Asia ETF, the Vanguard one at the bottom there, excluding Japan, because of course Japan is sort of looked after within this ETF. And the weightings here have really been reflected from similar all-world funds. So, S&P 500 is my largest piece of the puzzle, if you like, then followed by Europe, then emerging markets, then Japan, then the UK, and then essentially the rest of Asia there. Now, interestingly, if we look at the percentages on the right-hand side, we're up 25% with the US exposure, 28% on VERX, 31% on VFEM. The Japanese exposure, again, up nearly 35% there, 30% in the UK, but rather staggeringly, and almost quite frustratingly, the Developed Asia Fund, which only makes up around 3% of this global fund, the weightings, is up over, nearly 57%. So, yeah, probably done myself, out of service a little bit there. But, that's just at the moment. Who's to say that that particular region and that particular market is going to continue climbing into the future? So, yeah, like I say, this portfolio is my main focus for the time being. I put £1,000 in each month, but then I also top this account up to make that full £20,000 ISA allowance. And really going forward, this is where the bulk of my money is going to be. It's diversified, it's relatively stable, and this is the kind of groundwork in the portfolio. Yes, we've only made £1,400 at the moment. It's not even been a year. Once we hit maybe year 2, 3, 4, that's where you'll really start to see the growth come through in that compound interest. Okay, so moving over onto the Vanguard platform here, and I'm going to do something slightly different on this update. But to start with, we've got £46,500, or there or thereabouts. But one thing I haven't done is kind of shown you the split within this account, because not all of it's within an ISA. Part of that number is within essentially my pension account. Someone commented on a video recently, asking if I could do this split, so I'll do exactly that. So, of that £46,000, around £7,000 of that is within a pension account. Now, essentially, I came across an old workplace pension, and instead of letting it sit with the old provider, I thought I'll move it over to Vanguard. I can invest it myself, but ultimately I then have a visibility of this money. So let's have a look. I think it was, you can see there, July in 2023. I added £4,793.02, which was purely transferred from that pension provider. And this is something you can do, by the way. You don't have to keep your money in these workplace pensions. You can pull it out into your own pension accounts and invest it essentially however you like. That's exactly what I've done here. Pulled that money out and invested it in one investment. And since then, I've not touched it. Left it invested in one particular index fund, and you can see there, in the space of sort of 2.5 years, up almost 50%, so that's grown to just over £7,000. Now, I know this isn't life-changing money, but these gains are much greater than I was getting in the old place, sort of workplace pension provider it was with. So yeah, you can see how that's sort of steadily grown. And again, I've kind of forgot about this, really. Just put it in there and left it, because at least I know where it is. Now, if we go to the actual investments, so what did I actually buy? Now, it's the FTSE Global All Cap Index Fund, and it's the accumulation version, which essentially means it doesn't pay out any dividends. Any profits or dividends from these are just automatically reinvested in the background. But that kind of shows, I think, that you don't have to keep, you don't necessarily have to keep adding every month. Yes, it does help, but if you do have any of these old pension pots left anywhere, sometimes consolidating these, you could get greater returns once you've done your research. But yeah, one simple fund. This particular fund, I believe, is only available on the Vanguard platform itself. It's not an ETF, it is an index fund. But yeah, like I say, 100% weighting in there. this will just stay sat in there, and possibly what I may do is, if I ever move jobs in the future or find other pensions, I might consolidate them all within this account. But yeah, just thought I'd provide that breakdown there. So if we go back to the overall portfolio, let's take a look at the performance here. So you can see, with this being my oldest account, 13th of February 2023. So this video is pretty much bang on 3 years to the date. You can see I was slowly adding money in. Couple of £100 here, couple of £100 there. This is when, you know, that jump there is when I added in that pension allowance, essentially, that pension amount. It's slowly been averaging in. This is just me consistently at the start of every month, whether the market's high or low, putting in whatever money I could. And you can see over time, you know, at these numbers, when I first started, the idea of being at £10,000 or £20,000 was completely out of my remit. I just thought, God, this is going to take me years and years. And you do question it, thinking, God, is it even worth it? I'm so far away. But I hope this gives you an idea that, look, if you just stick to the plan, dollar cost average in, keep investing in, look, these numbers started to grow and grow and grow. And you can see now, you know, we're at a point now where we're almost at £47,000, which if you'd have told me that 3 years ago, that we would grow this account this much, I wouldn't have believed you. But yeah, top line stats, over £35,500 of my own contributions, because obviously I'm still doing the heavy lifting here. It's my contributions that's doing a lot of the work. And we've gained almost £11,000 over that period. Once we get past the £100,000, £150,000, £200,000 mark, that's probably where the compounding effect and the interest on average per year is going to overtake the amount that I put in. So you've got to think, if we average around 10% growth per year, and I've got £150,000 in there, that's going to potentially be £15,000 in gains just from that year, from me not adding any more. If I add £10,000 in there as well, then that's £25,000 the account's grown by, but I've only put £10,000 of that in and got 25 out from that year. So that's the end goal. That's where we're trying to get to with all these accounts, really, is so it's large enough that that snowball effect really starts. Let's take a look at the investments. So first of all, fairly similar to my InvestEngine account, but we've got emerging markets looked after by this particular fund. Total gain of £250 there. Again, similar fund to the InvestEngine account. My Developed Europe fund here, the Japan fund here, FTSE 100 ETF here, S&P 500 ETF here. I've also got an all-world fund. That one at the bottom is that one I showed you earlier in the pension portfolio, but you can see by far the S&P 500 has kind of been my biggest performer. In terms of actual percentage though, the all-world at the moment is actually doing better. Now, if you're watching this, yes, there is a lot of overlap. This is probably when I was still experimenting with different ETFs. If I was doing this again now, I wouldn't have all this overlap. I'd probably just stick it all within that all-world fund. But I kind of left it as it was because it seems to be performing. If I go into the month tab, so this is quite an interesting one when it finally loads. So this column here are my contributions. And you can see here that as of, you can see as of here, that as of April, I haven't added in another penny. And within that month, we were sat at around £37,500. I've not added another penny. And you can see the balance, how that compounding effect happened in the background. So for not adding anything from last April, from going essentially from £37,500 to £46,500, that's a £9,000 gain within that time, which is absolutely crazy. Now, yes, at the time of that April, there was around a bit of a dip. You can see the sort of losses we made within those months, but it just shows you that even at this sort of value, you know, a slight change in the market, a 5% gain, can really make an impact on this portfolio. So plan is, with this portfolio, I'm not going to be adding anything else into this for the time being. This will just be sat here compounding in the background. My main focus is on trading 212 and InvestEngine for the time being. If we go into investments and insight tab, very quickly cover where these investments are held. 68% of the stocks within here are within North America, then followed by Europe at 13%. We've even got 4% in the UK, 6% is in Asia Pacific, 6% in Japan. You can see the top 10 investments here, so no surprise there that it is dominated by US tech stocks and the Mag 7. But the sector allocation I'm quite happy with because it's fairly evenly spread. I haven't got all of my eggs in one basket, so 15% within the financials, then the technology industry, followed by industrials, and then all of the others there as well. So yeah, hope that gives you a quick overview of these three accounts. So now that we've gone through all three accounts, let's break down the maths and see exactly what these returns have been. Starting with Trading 212, I've invested £6,512.68, and that's now grown to £6,852.66. That's a gain of £339.98, which works out at a nominal return of around 5.22%. This account is obviously more focused on individual stock picks, so returns could be more volatile, but overall I'm happy with how this is progressing. I think we're just in a little bit of a dip at the moment, but I'm expecting the returns to rocket later in the year. Next up is my InvestEngine account, which, if you remember, this is my DIY global ETF portfolio. In this account, I've invested £17,000 and it's now worth £18,449.06. That's an increase of £1,449.06, giving me a nominal return of 8.52%. This is exactly what I want from this portfolio: steady, diversified growth without too much drama. And finally, Vanguard, my biggest and longest running portfolio. Here I've invested £35,603.02 and it's grown to £46,406.45. That's a gain of £10,803.43, which works out at a return of roughly 30.34%. This really shows the power of staying invested long term and letting compounding do its thing. So now let's zoom out and look at the bigger picture across all three accounts. So in total over the past 3 years, I've invested £59,115.70 of my own money. Right now my portfolio is worth £71,708.17. That means my investments have grown by £12,592.47 in pure gains, which works out at a 21.3% return overall. It's also worth saying that while I'm recording this, we are going through a bit of a market pullback. We've seen some volatility and a slight dip across a lot of markets recently, so these numbers aren't at all-time highs. So that almost wraps up this investment update. I'm really happy with the progress, but I'm also very aware that I'm heavily in the building phase. The gains are never going to be too ridiculous at this stage as we build to that £100, £150, £200,000 mark. My money is doing some of the work, but ultimately my contributions are still doing all that heavy lifting. And that's completely normal at this stage. This part of the journey is all about staying consistent, showing up month after month and contributing and building that initial pot of money. It's not all that glamorous sometimes, but this is the really important thing that will make all that growth possible later on. The plan from here is fairly simple. I'm going to continue investing primarily in that InvestEngine account. I'm going to leave the Vanguard account, and every now and then I'll try and top up some of the stocks within my Trading 212 platform. I am, however, thinking of making a few changes within my portfolios, but I am going to make a full video on this, so make sure you subscribe for that. If you've been following this journey so far, then I really appreciate your support. If you've got any more questions about anything you've seen in this video, then make sure you leave a comment below. As always, thank you for watching, and I'll see you in the next one.